Hello, welcome to this week's edition of the Market Carver. Adam is out this week, so I'm joined by Zach, who's going to be doing a great job talking to us about this week's performance for the S&P 500 among many other asset classes for 2025, and then comparing them to what we saw last year and some of the main takeaways that we discussed in our allocation meeting. I'm also going to be looking at going under the hood of the market. We're starting to see a little bit more strength. We're going to start looking at, are we getting a lot of stocks participating in the rally that we're seeing in the S&P 500? And that's going to be the first chart that we're going to look at today. So we saw the market see a really strong bounce after the April lows. It really only took 9 days for it to rally 10%. We continue to see the market go higher. Then over the last couple of weeks, we've seen a consolidation. The market's kind of digested some of those gains, gone sideways for a little bit, digesting some of the crazy headlines that we've been seeing. And here recently, we're starting to see, again, the market move higher. What we always want to evaluate whenever we see the market doing any type of trending is how many stocks are participating in that rally higher. When we start seeing new highs, how many stocks are making new highs as well? One of the early signs when we started getting a little bit cautious on the market going into earlier this year, before we saw the market decline, was we started seeing fewer and fewer stocks making new highs across time frames. And it's actually the chart that we have today. You can see coming into that high back earlier in the start of the year, we saw very few stocks making new 1-year highs, 6-year highs, or 3-month highs, as we really started to see the market become very narrow in its leadership and participation. Then we saw the market see its decline. We bottomed in April, and we've been rallying ever since. Now we want to start seeing expansion of those new high lists. This tells us that we're seeing a lot more stocks participate in the strength that the actual index is doing. And so what we're looking for right now is starting to see at least 5% of stocks hit new 52-week highs, see a broadening out of the shorter time frames. And that's something that we're not quite seeing yet, as we really have become really reliant once again on some of those mega cap stock names. And so we really want to see that happen to get confidence in another leg higher in the equity market, and not just rely on just a handful of 6 or 7 stocks to carry the S&P index on its back. Now, that's something that we saw happen for months and weeks and months in the past. So it's definitely possible, but a good, healthy market sees a lot of stocks rallying and moving higher along with the index. And that's what we're really monitoring below the hood. Now, like I've talked about, the market has started to bounce higher. Now I'm going to turn to Zach, who's going to do a little deeper dive into some of the performance and compare that to last year.
Yeah, so as we close in on the halfway point of 2025, the end of Q2 here in a couple of weeks, we thought it would be helpful to just take a step back and look at asset class performance thus far through the midway point of 2025 and compare that to what we saw through 2024. So as you look at the chart here, it kind of highlights a lot of main asset classes. There are some noteworthy standouts: gold, investment grade credit, real estate, certain asset classes that through the midway point of this year have already outperformed what their total return in 2024 was. We've talked about this particular point in the past, international markets relative to domestic markets. And I think that that's the most noteworthy point on this slide here. You can see the EFA equities, that's your developed market international equities, has already 3 to 4 times its 2024 performance, certainly the best year that it's had in a while. Emerging market equities has already outperformed its full year 2024 number. And that comes at the expense oftentimes of the S&P. You can see quite a lag in the S&P performance. It's a trend that we've talked about time and time again. And these cycles, this international versus domestic equity outperformance, can typically persist for several years at a time. So maybe at the beginning of that here, with international equities significantly outperforming the S&P so far, a lot of that ties into what Andrew talked about with breadth. You can see EFA, the developed market equities, up about 19% this year compared to about 2.5% for the S&P 500. And then even emerging market equities up a little over double digits, a little over 10%. So significantly outperforming the S&P there as well. As we look at these trends, and we want to be cognizant of not jumping too early, putting all of our eggs in one basket into the international market, but we have started to edge that allocation up to take advantage of the international outperformance in the portfolio. So something we'll keep an eye on moving forward, but certainly a trend that we've enjoyed seeing as we've started to overweight that segment of the portfolio.
Thanks, Zach. This has been a topic we've discussed a lot in the Market Carver, really looking at the strength and international. It's something that we really started to capitalize on and jump in throughout this year as we saw emerging markets, international markets really starting to strengthen. It's also a reminder, if you were watching the Market Carver at the start of this year, we also talked about how difficult it can be after we've seen the S&P 500 rally so strong for 2 back-to-back years, and how it's hard for it to really continue that move higher. And so we are still seeing equities do well. It's just shifting to be more international than domestic. There's always some strength somewhere, and that's what we're always trying to find on the allocation team, those types of opportunities. So if you have any questions about what we talked about today, or if you'd like to schedule a meeting with our advisors, please reach out at either the phone number on your screen or the website there, or there's obviously the QR code you can scan to make an appointment as well. We thank you for your time. We look forward to talking to you again in the Market Carver next week. Have a great weekend.